stock market heaves a big sigh of relief on possible review of tariffs on Canada and Mexico. Mid-caps lead the charge with utilities, realty and metals outperforming.
Coforge stitches up a hefty near a $1.5 billion 13-year contract with an American travel major, Sabre, making its presence felt in the big deals arena. The stock gets a leg up.
NSE bats for a uniform expiry date across all stock exchanges to curtail excessive speculation, says expiries on different days of the week by exchanges defeats SEBI's objective.
Amid signals of tariff talks with Canada and Mexico, U.S. President Donald Trump rages on in the Congress, backing reciprocal tariffs and barriers, promising tax cuts, more oil, and interest-free loans for automobiles manufactured in the U.S. India gets singled out for high duties on car imports.
Despite U.S. tariffs, China sees GDP growing at 5% with domestic push. A higher fiscal deficit will target help stimulate demand even as it stabilizes the property market and restructures its steel mills. Metals gain on cue.
Good afternoon, you're with us here on Halftime Report live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia. With me is Mangalam Malu as always, and some much needed relief on the screen, Mangalam. And the street would take that with both hands, especially because of the fact that a lot of these underperforming stocks are finally doing well today.
Take that point entirely, and it's after a very long time that we're seeing some short covering in the frontline end of things. We have the Nifty, which is crossed that 22,350 mark, a mark which has been a bit of a resistance zone for our market itself. 22,250 was a lot of call writers action out there. 22,400 was where a lot of call buyers took positions, hoping for this pop, given the sort of base formation move that we've seen over the last couple of trading sessions. Today, the star of the day has to be the mid-cap index. 2,300 stocks in the green for about 279 in the red itself. So it's a bounce, a powerful bounce from, after a big sell-off. Let's see whether that sustains or not. Case in point, something like a Trent, which is now up 6%. It's a Nifty stock, which had seen a big correction of almost 40% from its highs, and now suddenly surging after a big move that we've seen in the markets. It's a recovery. It's the one which is leading recovery. But it's actually the global markets which are on our radar. Amid signals of tariff talks with Canada and Mexico, US President Donald Trump rages in on Congress, backing reciprocal tariffs and barriers, promising tax cuts, more oil and interest-free loans for automobiles. India gets signaled out for higher duties on car imports. Let's hear out what Trump had to say, and then we get cracking on what experts make of this.
Other countries have used tariffs against us for decades, and now it's our turn to start using them against those other countries. On average, the European Union, China, Brazil, India, Mexico, and Canada, have you heard of them? And countless other nations charge us tremendously higher tariffs than we charge them. It's very unfair. India charges us auto tariffs higher than 100%. China's average tariff on our products is twice what we charge them. And South Korea's average tariff is 4 times higher. Think of that, 4 times higher. April 2nd, reciprocal tariffs kick in. And whatever they tariff us, other countries, we will tariff them. That's reciprocal, back and forth. Whatever they tax us, we will tax them. If they do non-monetary tariffs to keep us out of their market, then we will do non-monetary barriers to keep them out of our market. I have also imposed a 25% tariff on foreign aluminum, copper, lumber, and steel, because if we don't have, as an example, steel and lots of other things, we don't have a military, and frankly, we just won't have a country very long. As the tariffs will go on agricultural product coming into America, and our farmers starting on April 2nd, it may be a little bit of an adjustment period. We had that before when I made the deal with China, $50 billion of purchases, and I said, just bear with me, and they did. They did. Probably have to bear with me again, and this will be even better. That was great. The problem with it was that Biden didn't enforce it. He didn't enforce it. $50 billion of purchases, and we were doing great, but Biden did not enforce it, and it hurt our farmers. But our farmers are going to have a field day right now.
Right, so that is Donald Trump speaking about America first and reciprocal tariffs, etc. But thereafter, we got comments coming in which said that maybe they were willing to meet other countries midway as well, as the ante on tariffs were upped by the countries themselves. Satyam Pandey, who's the chief US and Canada economist at S&P Global Ratings, now joins us. Satyam, what do you make of this situation? Is it more, for the lack of a better analogy, bark than bite, or could there be bite and then maybe retaliate or retreat? How do you look at this situation right now? And in light of that, what happens to the US macros, and how should one look at countries like India?
Well, thanks for having me first. I would, take his words at face value. That's what we've learned to understand. You may have hopeful views, but he is pretty serious about putting on tariffs, and he's also serious about making deals. So he is a deal maker in chief, and if he thinks he's getting a good deal, he will compromise. And I think some of the reports coming out suggests that they may be looking for some middle ground with Canada and Mexico as well in the coming days. But he wants to start off with at least 25% on Canada and Mexico, and then the reciprocal tariffs after April 2nd. That's his opening stance, for the bargaining.
Satyam, thank you for joining in. Would it be fair to say that over a period of time, even if not now, Trump would have been forced to go back to the negotiation table, because unlike the first term, the countries on which he's imposing tariffs are retaliating equally aggressively, if not more?
Well, I'm not so sure if they are retaliating equally aggressively. I've seen more of a balance of symbolic, sort of retaliation, as well as some substantive. But, the other countries do want to strike a deal with him. It's just right now, it is at a point where we're still trying to understand exactly what is needed to strike that compromise. In terms of Canada and Mexico, he's been very vocal about the drug trafficking and some of the immigrant border control. And with other countries, especially when it comes to autos, he's been pretty serious about it. That comes up again and again. He did talk about the autos in his congressional speech today as well. That was one of the key sectors that he's looking to shore up. The other thing is anything related to national security, whether it's steel, aluminum, or some critical minerals that's needed for the defense, sector, as well as some other key new technology sectors. They are pretty serious about shoring up the industrial complex in the U.S. Whether it's going to happen or not over the next few years, that's yet to be seen. But they want to change that narrative, the industrial complex in the U.S. The other thing is he does want also the tariff revenues. They're looking for revenues, some source of revenue, in order to at least offset some of the budgetary plans that they have coming down the pipeline, like extension of tax cuts, which are going to require some offsetting revenues. So all of this sort of is in play right now, but there's definitely, the window for compromise if the other parties are willing to sort of, put forth their intentions as well. So.
What do these tariffs do to inflation in the US? That's point number one. And secondly, what happens to India?
Well, the tariffs in itself are generally inflationary. That's, quite simple. A lot of the extra cost is borne out by the importers. There are some exchange rate adjustments that could sort of help, partially at least. But at the end of the day, between the importers and the final consumer, most of the cost gets spread out. The consumers are quite sensitive with inflation lately. They've had quite a bit of a price level shock in the last 3-4 years. But again, we think that the way that it was structured, the 25% tariff with Canada and Mexico, that's about, and plus, 10% on China, that's about 42% of imports that the U.S. has. we are going to see maybe 60 to 70 basis point rise in the price level. So instead of a 2% inflation target that we were on the path to, you're likely going to see 3% plus, at least in the next 12 months. That's the trajectory that we're headed with these targets.
You know, very, very quickly, Satyam, due to paucity of time, would all of this result in a negative GDP growth for the US in the first quarter based on what the Atlanta Fed survey is indicating?
Well, the first quarter is already running a little bit negative, a lot of front running of the imports and those one-off January weather-related issues. But I think there will be a bounce back on February and March, but it is still going to be a softer GDP growth in the first quarter than what we had previously thought and what we had seen in last year. So maybe closer to 1.5% rather than the 2.5 that we had been seeing.
All right, Satyam, thank you so much for sparing time and joining us today on this issue of tariffs, and looking forward to having you more often on this platform. But where do we stand when it comes to women's leadership and progress in India? The Close the Gender Gap index uncovers key insights, while the Future Female Forward Charter sets the roadmap for real action. Be part of this movement. Tune in on the 10th of March at 5:30 p.m. only on CNBC TV18. Take a short break. Back on the other side. Welcome back. The markets continue to remain at the highest point of the day. 22,360 is where the Nifty is now. But one stock that is under pressure and has been so through the day is BSE. And that is after the NSE revised its monthly, weekly and expiry dates. Vamakshi is joining in with more details on that. Vamakshi.
Well, Hormaz, BSE is definitely reeling under pressure today. There was an announcement that came through from NSE. They said that they will be shifting the expiry date for the Nifty Index weekly derivatives contract from Thursday to Monday. The change will be effective from next month, April 4th, 2025, and this will be applicable to even the monthly, quarterly, as well as the half-yearly contracts and some other indices as well, which includes Bank Nifty, Fin Nifty, and several others. Now, given this announcement, why is BSE down today, right? That's the big question. Keep in mind that earlier on, BSE had revised its weekly contract expiry to Tuesday from Friday, with effect from Jan 1st. And when we look at the market share for BSE on Monday, since this shift has taken place, it has ranged between 20 to 22%, and on Fridays it has been on an average somewhere around 15 to 17%. So with this shifting of the NSE expiry to Monday, there is a possibility that there could be a possible volume shift as well from BSE to NSE, which is the reason why the stock is reeling under pressure today. A possible offset could be the fact that the market share on Thursdays may move towards BSE. Keep in mind that analysts say that the market share on Thursday has averaged between 5 to 7% since Jan 2025. But not just today. When we look at the trend in BSE over the last couple of sessions, since its high in February, the stock has corrected by over 30%. Keep in mind that SEBI had also published a consultation paper towards the end of February to bring down volatility in derivatives market, and Goldman Sachs earlier on had also alluded to the fact that this does not bode well for most of the exchanges, given that more than half of the top line comes from the derivatives segment. Given that, Goldman Sachs on Monday itself had maintained a neutral rating and cut down its target price to 4,880 for BSE. Overall, today the move can be attributed to the shift in NSE weekly expiry from Thursday to Monday. Given the potential shift in volumes that could take place, the stock is under pressure as of now.
Take that point, Vamakshi. Thank you so much for that. That's good insight coming in. In fact, earlier today, we spoke with Sri Ramakrishnan, who's the Chief Business Development Officer at the National Stock Exchange, to understand the rationale as to why they changed this expiry day and whether competition was one of the reasons why they chose this.
Single day for all expiries in the entire market is the real solution. And so proliferation of weekly expiries on every day of the week through multiple exchanges, like MSCI, for example, has a plan. Likewise, NCDEX seems to have a plan. MCX seems to have a plan. Then there could be OTCI who might come up with a plan. So proliferation of weekly expiries through multiple exchanges is no different from one exchange potentially offering expiries on every day of the week. So perhaps, the solution lies in one single expiry for the entire market. Responsibility to collectively upgrade and build capacity in the market. Yeah. And if that's the case, then we should be limiting expiries with respect to the expiry date. And you've seen, expiry day shifts being undertaken by other exchanges, and there are also some new exchanges who are planning a foray into equity derivatives to launch weekly expiries. I think it all follows from the SEBI rules, which require only one expiry per exchange. But if the intention of the regulators is to have one expiry, I think it makes sense to choose the optimal day of the week. The rationale for this decision is more to take into account the fact that there are lots of geopolitical events, developments over the weekend, and Monday is a great day to therefore have the expiries.
Just before we take that break, pull up Bharat Electronics as well. Just a few minutes ago, you saw some flashes on your screen about the company announcing an interim dividend of 1.5 rupees a share, and the stock has now surged to the highest point of the day after that dividend announcement, 2.5% higher for BEL. Take a short break. More on the markets on the other side. Stay tuned.
Welcome back. It's looking very good for the markets. The Nifty is at 22,350 right now as we speak. The key indices to track today, we have the Nifty, the big Nifty Bank and the Nifty IT stock, all of them doing extremely well. The Nifty is up around 1.5%. The Bank Nifty is up just 0.7%, but that's absolutely fine. It's the IT stocks which are leading the frontline index higher as well. What's on fire literally is the broader markets, 2.5% for the Nifty, mid-cap and the small-cap indices, with 10 number of stocks advancing for just about one stock which is declining. Add to all of this, the India VIX is lower. So that tells you that there is some support coming in from the bulls. There is put writing which is taking place in the market, though not by much, but a decline of 1% is what we've seen. What actually has happened today is that, the 22,200 call and the 22,100 call writers who believe that the market couldn't surge so much are being caught on the wrong side. And now, because they are covering their positions, there have been a further up move in these stocks itself. These options, look at that, 29 lakh shares uncovered in 22,200 call. We have the 22,100 call as well that comes up for you, unwinding of nearly 20 lakh shares out there, with the premium surging nearly 220%. The 22,200 put writers have come into the fray after this big up move that we've seen, telling you that the base of the market after today may have moved higher from 22,000 to about 22,150 odd. 1.5 crore shares written at the 22,200 put. And this morning we had spoken about punt buying having taken place at the 22,400 call. This morning, the option was 11 rupees. Right now, we're looking at the option price at around 62 rupees. So those guys have really luffed their way to the bank in today's trading session itself. A lot of long positions added on names like IIFL Finance, Irida and Coforge. Some shorts added on BSE. Will be very interesting to see how this capital market theme plays out. We spoke about IIFL Finance. Just look at Angel One as well. These have been ones which have underperformed, and if capital market themes continue and if the money has to shift out of BSE, does it go to sector or market agnostic plays like Angel One and IIFL Finance, whether it's NSE or BSE? These guys will still make the booking.
Indeed, they will. And you mentioned laughing all the way to the bank. I'm pretty sure they would have done laughed, danced, and possibly everything else to make, since they made money. But indeed, good going for the markets as of now at the highest point of the day, the Nifty and the broader markets as well. We'll take a short break, but just before we do that, here's some good news for our viewers. India's business news leader is now just a click away. CNBC-TV18's all-new app, which gets you instant access to breaking news, in-depth articles, and financial world updates on your fingertips. You can download the app from your App Store and the Google Play Store, or scan the QR code that comes up on your screen. Take a short break. Back on the other side.
Welcome back. The screen is looking a lot brighter today if you are a bull, and it's a big move that we're seeing in the mid and small cap end of things. But remember, don't lose sight of the fact that these indices and a lot of stocks have taken a big knock from the top itself. So small cap and the mid cap indices, while they're at the day's high right now, 2.5% each. If you look up a longer chart, from their highs, the small cap index is down about 23-24%. The mid cap index itself, despite today's up move, is still down about 20% from its 52-week high. So in a situation like this, what are fund managers doing, specifically the ones who manage the small cap funds, and are there any interesting bets after this drubbing is something that we'll get chatting with Resham Jain of DSP Mutual Fund, who joins us now. Resham, of course, co-manages the small cap fund for DSP Mutual Fund itself. Thanks a lot, Resham. Thank you for joining in. There's a big fall that we've seen in the small cap and mid cap names. Of course, this after a big rise as well, when everyone was saying that valuations are, out of whack and all those things. Right now, with the valuations having moderated, with the sentiment having soured in this mid space, are there any pockets that you're liking? And what are you as a fund doing right now?
So thanks for inviting. I think a good day to be on the show. After a long time, we have seen market seeing some uptick. But I think, as you mentioned, market has corrected by almost 24% from peak. Some of the fall is also attributed to earning kind of moderating. We have seen last 3 quarters, the earning itself has seen earning growth itself has seen some level of moderation. So out of 24%, if I bifurcate, roughly around 8% fall is coming just because of earning degrowing or earning resetting at a lower level. And roughly around 16-17% fall is because of PE re-rating or de-rating in a way. And PE, let's say September 24, when market was at peak, was close to 24 times, which has now corrected to 20 times. And if you look at last 10 years average, it is close to 18 times. So maybe one can argue that market can come to averages if it falls by another 10% or so. So this is one part of the story. The second part of the story is that index has fallen by 24%, but a lot of stocks have fallen by 30, 40, 50%. And that is where the opportunity lies. So obviously there are pockets which were very, very expensive, like capital goods, which used to trade at 40 times, 50 times, 60 times. Some of the companies were valued at significantly more expensive. They have come less expensive now. They are still expensive than their past, but they are a little less expensive than what they used to be. I think the areas where we are seeing some level of opportunity is on the consumption side, the small ticket consumption, especially in the small cap universe. They took a very large beating. These are good companies, stable management. They are there from last many years. But in line with what the small cap universe have fallen, they have also took a beating. So that is one space where we see a good level of opportunity. There are also opportunities in the manufacturing space where whatever is happening geopolitically, and it has been happening since last many years, some of these companies provide good opportunity, like textiles, chemicals, some of the forging, casting companies as well. So those are the pockets where we see opportunity. Obviously, we want to buy some of these good quality capital good companies. I think they have still not become cheap, but they have become more palatable. So from a 5-year perspective, if someone is looking at those companies, at least one can make money from these levels.
Resham, good afternoon. Thank you for joining in. So are you buying them when they are palatable, or still waiting for them to become cheaper? And how much more should they fall for them to fit your definition of cheap?
So I think there is this saying which says that when market goes up, you become quite optimistic, and when market falls, you become pessimist. So unlike that, I think obviously there is a lot of negativity right now in the market. And the only thing as an analyst or as a fund manager, what we need to look at is respect earnings. And so wherever we feel that earnings have been quite stable, despite the overall slowdown in a lot of sectors, we are going ahead and buying some of those names.
Are you buying newer names or are you topping up on names that you already have?
Both. So existing names, obviously, we become more happy when they fall because we anyways like them and they become more cheaper. So we like them and we buy those names. But on the other side, there are like this wish list. We want to buy those companies because of very good management, a very good business model. But because of valuation over the last 2-3 years, we couldn't participate in those names. Some of those names obviously have corrected, and those names are providing good opportunity.
Where would those wish lists stocks stand in your overall scheme of things when it comes to sectors? I'm not asking you for specific names, but if you could, guide the street into what is now, from your standpoint, looking a lot more attractive, new stuff.
So obviously, capital goods is one space definitely which has become much more palatable, which includes some of the industrial names as well. Healthcare is another sector where we see there is some correction which has happened, and valuations have also become much more palatable. And lastly, as I mentioned, consumption, because we have seen economy in a way over the last 3-4 years. A lot of capex driven things were happening, but there is incremental focus on consumption side as well. And some of those consumption names is where we are much more positive.
You hold RR Kabel as well in your portfolio, and recently there was a big announcement that came in from Ultratech. They wanted to enter the cables and wires space. Do you think what happened to the paints industry will happen to the cables and wire industry?
So typically, wherever you see faster growth, much longer growth, you will see players coming into those space. This is a very large sector. Obviously, there is a new player which is coming in, and obviously sentiments will get disrupted because of that, and that is what we have seen in some of the in the PE getting derated in some of those names. But I think over a 5 years, 10-year period, this is a space. If India has to grow, we need a lot of capex on the transmission side, on the overall power generation, power distribution side, and that is where these companies will keep growing. So obviously, some of these companies, because of recent sentiments, would correct. Probably that would provide more opportunity to look at that space.
All right, Resham, would have loved to chat with you a lot more, but due to paucity of time, we leave that for another day. Thank you so much for sparing time and joining us this afternoon there, Resham Jain of DSP Mutual Fund. Take a short break. The Nifty now nearing 22,400 as the short covering bounce continues on this midweek session. Stay tuned, we'll be right back. Welcome back. Nearing 22,400 is the index, but there are plenty of strong movers in the broader markets, and the Adani Group stocks are making a case for themselves in today's session. Adani Energy is up 8.5%, Adani Green is up 8%, Adani Wilmar is up 7.5% as well, and Adani Ports and Adani Enterprises too on the Nifty are doing well for themselves in today's trading session. Of course, Coforge, we continue to mention that it is among the top gainers on the Nifty 500. It's actually the top gainer on the Nifty 500, 9% higher there on Coforge as well. But some of the stocks that are bucking the trend in today's session, Anand Rathi Wealth is one of them. Mind you, the stock is trading ex bonus in today's trading session, but still 6.5% lower in today's trading session after that corporate action taking place. Bajaj Finance too, one of the few losers in today's session on the Nifty, 2.5% lower there as well on Bajaj Finance, with some of the others include the likes of Go Digit, Spark and PB Fintech. Not significant losses, but on a day when the broader markets are up 2.5%, these stocks are still in the red. We take a short break here on Halftime Report. On the other side, Manisha Gupta joins in with Kunal Shah of Nirmal Bang Commodities. Stay tuned, we'll be right back.
Welcome back, and joining us on the show now is Kunal Shah of Nirmal Bang Commodities. Kunal, hi, thank you so much for joining in. And the first word really on the base metal prices, because even as the tariffs have now been imposed, we've seen that coming on aluminum and steel, and then retaliatory tariffs from China. And these two countries, because are the largest trading partners, one of the largest trading partners, and definitely big in metals. One, how are you viewing that? And second, with the China statements coming in sense of their GDP and financial injections, and of course restructuring of steel, what is your sense on that too?
So first of all, I'm very bullish on base metals and other metals. China has also reiterated today that they are going to cut the production of steel. So that itself is very bullish. Number two, coming to the impact of, so whether this tariff thing which is going on, whether this is for the negotiations or whether it is going to stay, irrespective of that, metals are going to be very bullish, in very bullish trajectory, because China seems to be on the revamping. So if you see what has been happening with China from last 2 years, they are quietly observing whatever is going on right now. And now finally, they are injecting cash. Their real estate sector has stabilized. Their economy is doing well. So it seems that instead of buying any other instruments, why not to buy commodities? Because they are not going to put, so from last 6 months, China is redempting out of their money out of US bonds, and they are putting that in gold, silver, gold and other commodities. Why not metals? So I am expecting that I will not be surprised if China State Reserve Bureau comes up with a statement that they are going to buy base metals for the strategic reserves. So the overall outlook in this kind of scenario where the dollar index is weakening, bond yields are going down, the expectation of easing from US is increasing every day. So this is the perfect storm for what are we waiting for? China is stabilizing. So the base metal prices are going to shoot up at least by 10% in next 2-3 months. So I'm very bullish on overall metal complex. Copper and aluminum are my favorite picks. And I think the party is about to start.
All right. So when you say you're expecting 10% of an up move in the next couple of months, and aluminum and copper is what you are most bullish on, what is your sense really on steel then? This whole China restructuring, which they have been talking about for many years now, would you think that it would finally be implemented, especially with all this tariff background? And if that happens, we're looking for a quantum here, but how much of a support do you see in steel prices because of this?
Okay, so coming to steel, with this tariff taking place, and now because of this tariff, there are two options for China: either to dump their steel into international market in other countries. The other countries will come up with the retaliatory tariff or anti-dumping duty on them. So it is very clear that China has no option but to cut down the production of steel. So this is going to be supportive for steel. From the international steel market point of view, if China cuts their production because of what they talk about it today, that they are likely to cut their production. So I think the outlook on steel from the pricing point of view globally, the downside is very limited. And once the China starts cutting their production, you are going to see a gradual uptick in the steel prices in quarters to come. As far as India is concerned, there are talks of anti-dumping duties, which makes sense. Because if there are tariffs on China, 20% tariff on China, where China is going to put their steel? So they will try to supply to India or other countries. So there is a possibility that in order to start our domestic industry, there can be a safeguard duty in steel.
Well, that would make sense. Kunal, and even as we are looking at strong buying in metal prices today, we've also seen a percentage point of gain in the silver prices in the overnight market. Do you see silver taking a lot of cues from gold, which is almost on the higher side, and then the kind of run-up that we've seen in metals? Silver kind of is lagging the enthusiasm that we've seen in both of these sectors. What's your sense on that?
Okay, silver is the only commodity from last 3 years running in a deficit of more than 8%. So this is the perfect storm. So the scrap silver, which used to be one of the major hurdle for silver prices, the scrap supply is gradually seen dropping in India and China. So even the perfect storm is set in silver. I'm expecting silver prices to shoot up by 20% in next 3 to 4 months. So I am very bullish on overall complex commodities as a whole. And in precious metals, silver remains my favorite pick, and I think silver is going to outperform gold in 3 to 4 months period. So go long on silver. 96,000 is rates on current rate on India. I'm expecting silver to move up to 1,15,000 or 1,20,000 in matter of 4 to 5 months.
Kunal, thank you so much for joining in. That's a very, very bullish Kunal for you. 10% of an up move in metals in next 2 to 3 months, and nearly 20% of an up move in silver prices in next 4 or 5 months is what you could be looking at. But with that, that's all the time that we have on this show. Business Lunch will take all the action forward.